So today we are doing headline earnings per share. So far we're looking at earnings per share, and we've looked at two types of earnings per share: basic earnings per share, which we did in the first lecture, and diluted earnings per share, which we did last week. Basic earnings per share is for the shares that you have issued, isn't it? Shares, ordinary shares that are in issue. And diluted earnings per share is potential ordinary shares. They may or may not become shares. Yeah. So remember that we need to calculate maximum dilution, and when we have multiple dilutable instruments, we do that thing where we do the sequence of dilution, which we did last week. Okay. So this week we're going to look at a third type of earnings per share. It's called headline earnings per share. It's called HEPS. And when we calculate headline earnings per share, we calculate a basic HEPS and a diluted HEPS. Headline earnings per share is a requirement of the JSE rules, and it's therefore required for all listed companies. All listed companies have to disclose headline earnings per share, and they disclose basic and diluted headline earnings per share. In essence, headline earnings per share is really about disclosing an earnings per share that is operational in nature, and so therefore we adjust the profit numbers for capital items, and the calculation is done by if we're doing basic HEPS, we take basic profit and adjust it for capital items. If we're doing diluted HEPS, we take diluted profit and adjust it for capital items. The starting point is therefore, if I did a little thing here, basic profit over basic number of shares, and the starting point here is diluted profit over diluted number of shares, which we've been spending the last 2 weeks doing the calcs for, and then we do the adjustment. We do the adjustment here. HEPS adjustment there and HEPS adjustment here. And these HEPS adjustments are for capital items. So if I was to highlight, here's the HEPS adjustment for capital items, and here's the HEPS adjustment. So our calculation starts with what we had already worked out. It starts with basic profit, and then I make the adjustments, which are capital adjustments. Or I start with diluted profit, and I make the adjustments to profit, which are my adjustments. The adjustments on both sides are the same adjustments. Do you agree? Exactly the same adjustments. So the adjustment here and the adjustment here is the same adjustment. It's just my starting point that's different. This is basic, that's diluted. That's after I've added back the interest and added back the saving of the dividend, etc., that I worked out last week. The adjustments that we make are in a circular that was issued by SAICA. And what the circular does is it goes through each standard and tells you whether to make the adjustment or not make the adjustment, right? So the first standard, for example, that it looks at is IFRS 2, which you know nothing about because it's share-based payments, isn't it? But let me find one that you do know about so that we can see. Let me make it look like that. So this is in your study guides. It's page 184. They've basically put in the circular. Let me show you how many pages it is. 1, 2, 3, 4, 5, 6, 7. So you could go learn it. By the time you get to honors, it's open book, so you've got it with you, isn't it? So I'm just going to quickly highlight the main things that we're adjusting. But in an exam situation, if you don't want to go learn the whole formula, we are adjusting things that are in profit and that are capital in nature. Okay, so let's look. You'll see that they have two columns, in and out of HEPS. And it's the out of HEPS that we're making the adjustments for. Do you agree? So let's just have a look. So IFRS 2 you know nothing about. IFRS 3, groups, goodwill. Yeah? Goodwill impairments we adjust for. They're capital in nature, isn't it? It's not operational if I happen to impair goodwill. So goodwill impairment is one that if you come across, you will adjust for. Bargain purchases, gains from bargain purchases, you will adjust for. They are once-off transactions, capital in nature. They do not belong in earnings per share. We remove them, isn't it? Remember, the removal is the opposite of the way it went in. A goodwill impairment would have gone in as a minus. When I remove it, I add it back. A bargain would have gone in as a plus. When I remove it, I subtract. So just remember, just be careful with that. So that's IFRS 3. Then there's some more adjustments with disposals, gains or losses on disposals of subsidiaries. And I guess those we can talk about high level. Gains or losses on disposals. Those are also out. Capital in nature. I sold an investment in a subsidiary. I've made a gain or I've made a loss. Do you agree? It must come out. Must come out. IFRS 4, we don't even deal with IFRS 4. It's not included in the syllabus. It's insurance. IFRS 5, discontinued operations. Those of you that have done FAC3703 know about discontinued operations, isn't it? But I don't think it's something that you're going to come across here because it's very technical in nature, so I'm not even going to highlight it. IFRS 6 is mining. IAS 2 inventories. Maybe it's a good one to stop on. Look, write-downs or remeasurements of inventories, inventory write-offs, stay in. They're considered to be operational. So if I write off inventory, it's considered to be part of my day-to-day business. It stays in. I don't adjust for that. Construction contracts we don't deal with. Also, it's out of the syllabus. Tax. Tax rate changes. Those also come out. They're considered not to be things that are operational. But you're not going to come across those in this module. It's too detailed. Yeah. I'm just trying to pick up the things that you are likely to come across. Then we get to IAS 16, which is PPE. They love to put PPE everywhere. So what's interesting here is PPE, impairments and disposal gains or losses are out. You see, impairments, disposal gains or losses, compensations for assets lost, although I'm not even going to highlight that one because it doesn't come up that often. Out. Sorry. Those ones are out. Impairments and... Oy, oy, oy. Now, what have I done? So those ones are out. Sorry, I was highlighting in pink. Depreciation stays in. It's considered to be an operating cost, isn't it? It happens every year. It gets put in depending on how we're using assets, isn't it, to make profits. But impairments don't happen all the time, isn't it? Disposals of assets don't happen all the time. So those things are adjustments, capital in nature. Sorry, I just wanted to see what else was on this page. I wanted to touch on revals. Gains on revals. Now, revals normally we would assume are capital in nature. Do you agree? So we should adjust for revals. It's an important thing to bear in mind. Gains on reval are in OCI, not P&L. Do you agree? Revals are in OCI, not P&L. So therefore, do I adjust? No, because remember, when I start my calc, I start with profit attributable to parent shareholders, isn't it? Not OCI. I don't take total comprehensive income. I just take profit. So revals are in OCI, they're not in P&L. So it's not even in the number that I'm adjusting. So therefore, when they tell you that there were revals, you ignore those because they're not in P&L. If they had been in P&L, we would adjust it. And you'll see when we get to IAS 40, which is investment properties, we do adjust. Employee benefits, there's nothing there because employee benefits is normal operating costs, salaries. IAS 20 government grants, stay in. Forex, we don't deal with Forex in a great amount of detail in this section. We deal with it in another section. So translations would not be in, but that I'm not even worried about. Gain or losses on loss of control of a subsidiary, also not something you're likely to see. Disposals, I've already touched on, hey, disposals of investments, so those are out. But this one is specific to associates and joint ventures. IAS 36 impairment. We already did say that impairment is out. Yeah. So here's impairment. Impairments or reversals of impairment are definitely out. Provisions stay in. Provisions are considered to be things that you're doing on a daily basis. Any adjustments to provisions stay in. Impairments or disposals of intangible assets, those come out. But amortization stays in. It's the same as depreciation, isn't it? That one stays in. Financial instruments, all remeasurements that are recognized in P&L, those come out. So I don't know why they put I don't understand what that is. But any remeasurements that are included in P&L come out. Be careful because you know that we have those that are measured through OCI, isn't it? Fair value through OCI. If it's in OCI, then we can't adjust because it's not in P&L. So it would only be fair measurements that are in P&L. That's 20. Here's 40. Investment property, remeasurements, again, fair value measurements for investment property come out. Yeah. 41 is agriculture. IFRIC 17, distributions in joint ventures, I think, of non-cash assets to owners. Yeah? So what do you see as the trend? Capital items, isn't it? Capital items, remeasurements, write-offs, profits or losses on disposals, those kind of things are the things that come out, isn't it? So headline earnings per share is disclosed in one of two ways. The long form or the short form. Here's the short form. In essence, the difference between long form and short form has to do with tax. Yeah? Has to do with the net of tax number. So all they do is that when they give you an adjustment, so they say to you, impairment of this, it's gross, isn't it? They're not going to give you a net number. So you have to take the tax off. So there's two, sorry, you're looking for the page. 191, you've got it on 189, 192, something like that. 193. Yeah, it's always about 2 pages out. Okay, so this is the format of the long form. The long form, you'll see, starts with profit attributable to ordinary shareholders, which is from our basic calc, isn't it? So this is basic. No, this is P&L. Then there's my cumulative pref, and this is basic. IAS 33 earnings. Do you agree? P&L down to basic. Here are my adjustments. Yeah, HEPS adjustments. And this is important. HEPS adjustments are after tax and after NCI, after minorities. Why? Profit attributable to ordinary shareholders is after NCI, isn't it? We will sometimes see little NCI pieces here. I'm going to take you through a question so you can see. But what they show here is they show the gross, which is the pre-tax, and then they show the net, which is the after-tax, yeah, in 2 different columns. And let's look at the types of things that they've put in here. Gains on disposal of land and buildings, gains on disposal of PPE, impairment of trademarks, remeasurement of associates, headline earnings. Yeah. If you look at short form basically puts, it's the same information, but they put the tax in as one line. So profit attributable, less prefs to get you to basic, then from basic all the adjustments, and then total tax effect, giving you, and total NCI, giving you the net number. So you'll see that I prefer short form myself. I just think it's easier to do. Total tax, total NCI. Yeah, but you're allowed to do either one in the exam as long as you show disclosure. Yeah. Let's have a look at the example. So the example, they don't actually say, do they say anywhere what their preferred is? Oh, okay, they say you must use the long form. The long form is to be included in annual financial statements. They're saying the short form is only to be used in interim reports. All right, so you need to have the two columns, gross and net, and the net column is after tax, after NCI. Okay, so actually just learn the short. After tax, after NCI. And I'm sure I've seen the short form used though in questions. Anyway, we shall see. So if you look at then the next page, there's an example, 29. It is page 195 for you, more or less, I think. So it has an abridged trial balance, a group trial balance of Husky and its subsidiary. And it's a very funny trial balance because it's got some pieces that say Husky, some pieces that say Ppe. I'm not exactly sure. But there's the whole trial balance and then additional information. They say they have 100,000 shares in issue. There were some share options which were granted to employees for diluted. Husky has a 75% interest in its only subsidiary, so we own 75, NCI is 25. SA normal tax of 28. And we go straight into the solution. Okay. So your starting point for me is to take these numbers, which they have here, and to work out for me a basic and diluted earnings per share. Yeah? So you're just basically going to take all the P&L items for Husky to get a profit for Husky, all the P&L items for Ppe to get a profit for Ppe. You're going to take NCI off to get attributable to parent. Make sense? And then you're going to divide by the number of shares to get a basic earnings per share. And then for the dilution is stock options. If you remember how stock options worked from last week, the free options get added to number of shares. Add to number of shares. So your basic profit and your diluted profit seems to be the same, unless there's some convertible prefs or something here, but I don't see anything. No. It looks like this from here. This is financial position, and the rest seems to be P&L. Look, they've even already worked out non-controlling interest. Yeah. So this is P&L up here. Okay, so you're going to start with basic and diluted. Then once you've done that, you can go and check your numbers. It'll be in the solution right at the beginning. Then you're going to set up, just to check that you've got the right starting point. Then you're going to set up a long form. and you're going to make your adjustments for your HEPS. Yeah? As you go through it, you can see like a lot of it looks ordinary stuff. The stuff that doesn't look ordinary, there's a loss on write-down of inventories. Rent, sales, opening inventory, purchases, all sounds ordinary. Closing inventory sounds ordinary. Municipal charges, telephone, interest paid, salaries and wages, all sounds ordinary, isn't it? Depreciation, I need you to consider. Gain on reval of PPE, impairment of PPE, loss on sale of write-down of inventory. Be careful, some of those numbers are puppy. That one's puppy, that one's puppy, that one's puppy, this one's puppy. So the ones that are puppy, less tax, less NCI to get the net number. Okay, let's see how it goes. They just do a calculation, or they do disclosure. Here's the numbers they get to. See if you can get to these numbers. Basic headline earnings per share, diluted headline earnings per share, 283 to 70. Just so that you also have a starting point, basic earnings, 521, 850, because you're going to have to add up all those columns, just so that you can check that one. Headline earnings per share. They do like to ask it. Especially if they ask basic. If they ask you just to do the basic earnings per share, they like to say basic and basic headline earnings per share. If they ask diluted, then it's already a lot more calcs than normally there. They don't ask for headline. Did you get this? Did you guys get this number? 521, 850? Because you had to leave out the property reval, right? Okay. So essentially, earlier when I said that all these items are P&L, I was actually just tricking you a bit, because I wanted to see if you would pick up that the reval of property is OCI. If you add up all these numbers, excluding this one here would have landed up in OCI. So it's not included. If you add up everything else except for that, you get 521. Is it 850? Yeah. 850. That's your starting point. Yeah? There are no pref shares, so there's nothing else to adjust. That is basic earnings, basic profit. And now you're going to adjust for what you think needs to be adjusted. You remember from what we said, depreciation doesn't get adjusted, isn't it? So not depreciation. Write-downs of inventory, do those get adjusted? No, it's operational, isn't it? So depreciation and inventory write-downs are considered to be part of your normal business. It's not capital in nature. So then that only leaves two adjustments, two capital in nature adjustments. A reval of the property and an impairment. One of those is in Husky, one is in Puppy. You must do it after tax, after NCI in the net column. Okay. And then you should have got, you should get this number once you're done. You did? Okay. For diluted, you're just going to have to adjust the number of shares for those free options to get your diluted. It adjusts by 5. You can see there it goes from 100 to 105. And that's how come diluted is a different number. So a little bit of groups coming into FAC3703, unfortunately. Although, of course, you know that by the time you get to honours, it's all integrated, eh? So there could be groups in a PPE question. There could be PPE in a groups question. It's all mixed up. Let me do the adjustment here as well. Let me do my calc. Okay. So we start with the 521,850. All we did was added up all those numbers and excluded or left out the profit, the gain on the reval. The reval. Because reval goes to OCI if it's reval to do with PPE. So 521,850, then we looked at all the adjusting numbers. Usually you just look at the funny ones they give you, isn't it? Depreciation and inventory stays in. The only thing that's going to come out is the impairment and the fair value on the investment property. Fair value on investment property would have been a plus, so I remove it, it's a minus. And tax on that is CGT, capital gains. Then the impairment would have been a minus, I remove it, it's a plus. Tax is at 28, it's a minus, it goes the other way. Tax always goes the other way. And then I take out NCI, which is 25% of that net number. 25% of the net number. I land up with basic headline earnings per share. Earnings. Basic headline earnings, not per share yet. 283,194. Number of shares is 100,000, so basic HEPS, 283. Diluted, there were some stock options. The numbers they gave you were exactly half. So half of the stock options are free, half are for value, because it was a 4 and an 8. So the free options are 10,000. But the stock options were granted halfway through the year, so I'm only going to include them for half a year. So only 5,000. So divide by 105, 270 is diluted HEPS. They ask you, I think, to do a calculation often often here it's a calculation. Do they ask you? Calculate basic HEPS. So that would have been your calc. Disclose headline earnings per share and diluted headline earnings per share in the notes. The disclosure in the notes is that long form disclosure. So if I start, there's the calculation, which I'm not going to go through. I just went through the calculation with you on my scribbles. Calculation. There's the 283 and the 270. Okay, here's the note. It's in a special note because headline earnings per share is not required by IAS 33, and it's not therefore disclosed in terms of IAS 33. Remember, earnings per share is disclosed at the bottom of the P&L. So this one won't be at the bottom of the P&L, it's only in the notes. So in the notes, there's a headline earnings per share note, which will say what is basic and what is diluted HEPS. And then we reconcile between the two using the long form. So the long form starts with my basic earnings, 521,850, and puts in the adjustments, gross, 310, and then net, which is after tax, after minorities, or NCI. So 300 after tax was 244,056, and 10,000 after tax of 28, after minorities of 25, is 5.4. Headline earnings, 283,194. Yeah, and remember that headline earnings doesn't change number of shares. It's just earnings. So what is headline earnings per share? A requirement of the JSE rules, required for all listed companies only, and it is an adjustment to adjust capital items out of profit, because those capital items are not happening every year. Yeah, I think it's mainly there to remove gains, isn't it? If you think about it from the shareholder's perspective, you could look like you've done so well this year, but all you did was you sold something for a lot of money, isn't it? Or made an unusual gain of some kind. So we remove those, and we only then are left with things that are truly operational in nature. Almost all countries have similar-ish earnings per share numbers that they disclose, yeah? Headline earnings per share. So that's headline earnings per share. The other thing that I wanted to do with you today is dividends per share. So far we've done basic earnings per share, diluted earnings per share. We've done headline earnings per share, basic and diluted. It's the same adjustment. Do you agree? It's exactly the same adjustments that we make to get to those numbers. And now we're going to look at dividends per share. Dividends per share, DPS, is a requirement of IAS 1. Dividends per share are disclosed in the statement of changes in equity. At the bottom of the statement of changes in equity, do you agree dividends go in statement of changes in equity, isn't it? Retained earnings column. So at the bottom of statement of changes in equity, we would disclose dividends per share. Dividends per share is far easier to calculate than earnings per share, because dividends per share is based on dividends paid divided by number of shares, not weighted, not nothing, number of shares. That's the basic rule. There's a little bit of an adjustment which I'll talk to you. So the basic rule is dividends per share are calculated on the dividends that were paid divided by the number of shares that got a dividend. Yeah, number of shares receiving the dividend. Usually, there are 2 dividends paid in a year. So we would have a disclosure for the interim dividend paid and the final dividend paid. Most companies declare 2 dividends in the year, one based on interim results and one once they finalize the financial statements. And so you would have 2 dividend per share numbers, one for interim, one for final. When I say that we look at the number of shares that received the dividend, it's important to track movements in shares. And we would track the movements in that weighted average calc, isn't it, that we do? But remember, we're not weighting. No weighting. We don't do any weighting. We just track movements, because if there was a share issue halfway through the year, then maybe there was a dividend declared at the beginning to less shares, and then there was a share issue and there was a dividend declared at the end to more shares, isn't it? So we have to track movements in shares. There's no weighting involved, but we have to track movements to figure out how many shares got dividends. Right, now I said to you that it is a simple, easy calc, but there is one adjustment. And the adjustment is for cap issues. And when we have cap issues, we will disclose something called an adjusted dividends per share. Let me show it to you by means of a brief example. Let's assume that in prior year, the company paid a dividend of in the prior year, the company paid a dividend of 50 million rand. And let's assume that they had 50 million shares that got a dividend. So dividend per share was 1 rand. Yeah. In the current year, let's assume they still paid a dividend of 50 million rand. But let's assume that during the year there was a cap issue. And so this cap issue would have resulted in the number of shares, let's assume, doubling. There was a 1-for-1 cap issue. For every share you had, you got a share. So now when we look at dividends per share, it's now dropped to 50 cents per share. Yeah? Are the shareholders truly only half as wealthy? No, because for every share the shareholder had before, he's now got 2. So whereas before he got a rand, now he's also got a rand, but he's still only got 50 cents a share, isn't it? When this happens, we disclose something called an adjusted dividends per share to adjust for the cap issue. Why? So that there is comparability. So we will still show the actual dividend per share that was paid. Because when somebody goes and looks in the newspaper or looks at what they actually received or looks at last year's financials, it's going to say that the dividend was R1, isn't it? However, because of comparability, we will do an adjusted dividend per share for cap issues. And we will then say, if the cap issue had happened, because remember cap issues we don't get value for, isn't it? So if I did a cap issue, my profit's not going to increase. My dividend's not going to increase. If the cap issue had happened, the dividend would have been 50 cents. And so now it's comparable. And now the shareholder's not thinking that his dividend's halved. Yeah. So there's an example. Page. And now, where's the page number? Is it there? 176. 178 more or less will be yours, I imagine. Example 23. 177. Novik. Novik had the following issued shares for December 09 and December 1990 and 1991. They had ordinary shares amounting to 2.5 million in 1990, 10 million shares. Sorry, at end of year they have 10 million shares. At beginning of year they had 4 million. So there's obviously been a change, isn't it, in number of shares. The following changes took place to the capital structure. There's also some cumulative prefs, but that's just going to be a dividend, yeah, to adjust profit. On the 1st of July, they had a share issue. They issued 1 million shares. So it went from 4 to 5 on the 1st of July, right? So if I do a timeline, just for dividends per share, I don't need to do the weighted average because I don't need it, isn't it? I would start beginning of year with 4 million shares. Then the 1st of July, which is halfway through the year, 6 months into the year, plus 1 million. I now have 5 million shares. And then on the 1st of October, they issued 5,000 shares by way of a cap issue, 1 for 1. So 1 October, they had a 1 for 1, and at year end, I now have 10 million shares. Yeah. The profit was 600,000 Rand, and this is the dividends they've paid. I'm only going to worry about dividends per share for this question, but I'll show you the earnings. They paid an interim dividend on the 30th of June, 91. And the previous year, they had paid an interim dividend of 70. And then on the 31st of December, at year end, they paid a final dividend of 120. And the previous year, they had paid a final dividend of 80. Yeah? So when we're working out dividends per share, it should be fairly easy to work out. Assuming there were no changes in the previous year, the previous year's numbers is going to be for that one and this one, I'm going to just divide by 4 million shares. Do you agree? For my interim dividend of this year, it was just before I issued that new issue, isn't it? So it's also 4 million. Not a Rand. 4 million shares. Number of shares. But then for my final, I now had 10 million shares. And I'm just looking up there and seeing that up there I also said rands, but it's not rands at all. It's a number. Okay. Do you agree? So dividends per share is a very easy calculation. It's the dividend paid divided by the number of shares that received that dividend, isn't it? That were entitled to the dividend when the dividend was declared. So if I do they ask for calculations or disclosure? Disclosure. Statement of changes in equity. Yeah. For the year ended, and they're just showing the current year. Dividend attributable to ordinary shareholders And here it is, 2 cents a share. Oh, there's the comparative. Also 2 cents a share. How can that be? Is that the comparative? Okay, I don't know why it says that. 2 cents and 2 cents. Okay, but here's the note. Dividend per share. The dividend per share was adjusted as follows for the cap issue. In 91 and in 90, current year, prior year. Interim dividend, current year, 80,000, 4 million shares. Prior year, 70,000, 4 million shares. 2 cents, 2 cents. Final dividend, 120,000, 10 million shares, 1 cent. Prior year, 80,000, 4 million shares, 2 cents. Yeah? Actual dividend paid. Because I had the cap issue, I'm now going to do an adjusted dividends per share. The adjusted dividends per share is only going to change for the cap issue. Yeah? So what you'll see will happen is whatever I had before, I'm going to apply a cap issue to it. A 1-for-1. So where my interim dividend that I paid this year was 80,000 for 4 million shares, I'm now going to say 80,000 for 8 million shares, and I'm going to adjust it and land up with 1 cent. Yeah. Then for the other year, I'm going to do the same thing. So where I had 4 in both cases, I'm going to apply the cap issue, and I'm going to land up with 8 and 8, and I'm going to land up with 1 cent and 1 cent. Again, 70 and 80 over a million. Yeah. Remember here, I don't adjust anything because this was after the cap issue, isn't it? But when you look at the information, it looked like last year I paid 2 cents and 2 cents. This year I paid 2 cents, and then when year end came, I only paid 1 cent, isn't it? I halved the dividend. But when I adjust, then it shows that actually I've always paid 1 cent, and I'm still paying 1 cent. Yeah? So dividends per share. It's just a question of tracking the shares and working out the number of shares, and then calculating the actual adjustment for the cap issue to show adjusted earnings per share, dividends per share. Now, I always used to say to students, dividends per share is never examined. But then there was a year that they didn't ask earnings per share at all. They only asked dividends per share. So that's the question we're going to do today, is that question where they asked for the dividends per share, just to make sure that we can do it, since this is today's topic and there are no other questions. We're done with the assign. No, we're not, but we just have leases to do. Okay, I must just find it now. I'm sure I have it here in my handouts. Here we go. May, June 14, question 1. Let me find it. And then I'll go and make a copy for you while you attempt it. It wasn't that long ago either, right? May, June 14. No, that's the solution. Don't save. It's this one, right? Yeah. Tool. And now? Oh. No, here. It's here. Question 3. I'll print. Okay, so there it was. It's 9 marks. So earnings per share is very nasty because you've seen how much work it is, isn't it? You have to learn like tons of different things and different ways of making adjustments, and there's like lots of moving parts, and then you get to the exam and they ask for 3 weeks of work that we did, they ask 9 marks. And you can just like slit your wrists there and then. So they asked 9 marks. That's all they asked in this paper for earnings per share. They asked just this, 9 marks, dividends per share. They asked you to disclose the dividends per share and adjusted dividends per share as it would be presented in the notes to the financial statements. That's it. Okay, there's the information. Build manufacturing had, as at 31 January 2012, which is beginning of year, ordinary shares, cumulative prefs, and non-cumulative prefs. The following transactions took place. They issued some shares and there was a cap issue. The profit after tax is a certain amount, and the same for the previous year. And then they paid an interim dividend and a final dividend. Yeah. They give you last year's profit, but I don't think they want comparatives. No, comparatives are not required. Always check. Usually we assume not comparatives, but with earnings per share, just always double check. Okay, so let me see if you can do that. And that was it. And you'll see when we start to do past exam papers, unfortunately, earnings per share is never huge. And it's so much work. And there's just, sometimes I look at it and I think, geez, I did 3 weeks of work for 9 marks. But there just isn't a way to do it quicker, isn't it? Because, look, they ignored basic participating prefs, they ignored all the diluted, the headline earnings, and they just asked dividends per share. But they could have asked so many other things, and they just didn't ask them. It's just the way it is. So try to do that one. I'm going to go make a copy for you then of the paper. Is that what you got? Okay, so we have a quick look. The movement in number of shares, which is the first thing that you need to be able to do. Beginning of year was 700. I had a share issue 7 months into the year, 200,000 shares. I then had 900, and then I did a 1 for 3. Was it a 1 for 3 cap issue? 1 for every 3, 300, total number of shares 1.2 million. The interim dividend was paid. It was an interim dividend of 612, and it was paid before I did any changes. So the number of shares was 700. Dividends per share, 87 cents. A final dividend was paid. The final dividend was 918,000. It was paid at the end of the year. 1.2 million shares, 77 cents. Okay. Then what I need to adjust is I need to adjust this number for the cap issue. So I need to add a third. So I divide by 3 and then I add it on. Yeah, 1 for 3. So I divide it by 3 and times by 4 basically, isn't it? Divide by 3 and times by 4. And I get that number, 933333. And so then I have adjusted dividends per share, which is this final number here of 66 and 77. So these are the two numbers. And so in my note, a dividend per share was adjusted as follows for a cap issue. Paid 87.77, adjusted 66.77. It looks better, isn't it? When I look at what I paid, it looks like I've dropped the dividend. I've paid a lower dividend. And remember, with dividends, we do it in MAC 3702. The main aim of a financial manager or director of a business is to not surprise your shareholders, to meet expectations. So don't do things that are too good or too bad. If you think at home with your parents, you don't want to do anything to surprise them, right? You don't want to do things that are bad. So if something bad's coming, you want to prepare them and make sure they know that it's coming. But you also don't want to do things that are too good, because then they're like, okay, why did you load the dishwasher exactly? What's going on? What have you done? Isn't it? So it's the same with shareholders. We don't want to surprise them one way or the other. So we try to keep things even keel. So this looks more even keel, isn't it? Then that's a drop. Nobody likes that. We also don't like it to go the other way, because then you start to ask yourself why are things looking so good. Dividends per share, 9 marks. But it doesn't get any better than that, right? Remember I said to you it's a very cruel section of work, this earnings per share. I was having a look at some of the past exam papers. Let me see if this one is one that's got a whole lot. October 12, it was 17 marks. Okay, 17 is not so bad. They asked for basic and headline, 17 marks. Then May 12, question 4, May 12, the earnings per share was 14 marks. Basic earnings per share with participating prefs, that one. Yeah. And I'm sure you look at it and you think, oh gosh, because remember it was that big table, isn't it, where we had to split the profit. Participating prefs, that one, 14 marks. Then October 11, we're going backwards in this one. October 11, earnings per share was 19 marks. May 11, it was only 10 marks. Yeah. Then 2013, I think I saw October 13, it was 12 marks. Small. May 13, here's May 13. May 13 was a bit more. It was 23 marks. Basic and diluted earnings per share. But then we saw now May 14, 9 marks. So it can be, you'd have to do a lot of work, because there's so many different things that it could be. And then they could ask you just something arbitrary for 9, isn't it? Do you agree? We've spent so much time doing basic and diluted and headline, and now we spend half an hour maybe looking at dividends per share, and that's what's in the exam for 9 marks and nothing else. So that can sometimes happen with earnings per share. Also, it's usually not a separate question. So this one we saw it was a part B, completely separate, but sometimes it's included in the question, and they'll just give you a story during their big story about what they've done to raise finance for something, maybe for a machine or whatever it was, and then they ask you to calculate earnings per share. It's an interesting topic for honours, because in honours they won't ask you to disclose or calculate earnings or dividends per share necessarily. They will say to you, prepare a statement of changes in equity. And if they give you a dividend, which you know they do when we do a statement of changes in equity, they expect you to calculate and show the dividend per share. If they ask you to do a P&L, a statement of comprehensive income, and they have given you number of shares somewhere in the question, they expect you to calculate earnings per share, diluted earnings per share if there is, because it's part of the disclosure of a statement of changes in equity and a statement of P&L. Yeah? So at third year level, they will ask you to do it, but remember when you get to honours, they won't necessarily. And then you'll get to the solution and you'll see that they've done an earnings per share, and you think, but they didn't ask us to do earnings per share, but they gave you the information, and it is one of the things that goes in that statement, isn't it? Just like statements of changes. I am a bit disappointed with this disclosure. I'm going to try and find a better disclosure for you. This one that I showed you here, where they just say 2 cents, 2 cents. Mind you, I don't even know how that works. That isn't even the full dividend, that 120, right? Is that the interim at the top and no, that's just the final dividend. So where's the interim dividend? It's not even in there. right? Because the total dividend was 80, 120 this year, last year 70, 80. Those should be the dividends that are there, isn't it? So it doesn't even look like the solution is correct. Or does your solution look different? It's the same. Do you agree that the total dividend that was paid, if we're doing a statement of changes in equity, was not just the 80 for last year? It was 80 plus 70, and this year was 120 plus 80. So maybe it's just missing a thing. It should have said interim final and then shown the numbers and the cents. That's what it should have shown. So that's not good. I didn't like it when I saw it, and now that I look at it again, it looks wrong actually. And for earnings per share, here's the disclosure. We don't do a lot of work on disclosure, isn't it? I've never asked you to do a disclosure, but just remember that all your disclosure is a reconciliation, basically. So we're reconciling from P&L to basic to diluted, and then from weighted average number of shares for basic to diluted. So it's just a recon, the disclosure. And then this one's dividends. Okay. So that is basic and headline. Next week, we're going to start leases. So leases is, again, 3 lectures. And but leases is big in the exam. Hey, it's about a quarter of the paper. A big question will be leases. Again, we're going to do a number of different types of leases. We're going to do about 6 different types of leases. Operating and finance for lessees, for lessors, and then sale and leasebacks and manufacturer dealer lessors. So 6 or 7 different types. You have to know which one it is. The accountings are all different. But then in the exam there will be one, isn't it? One of them will be in the exam, not all of them. In second year, they like to ask operating leases, but in third year, they will ask finance leases. And sometimes they ask both. So they ask a little bit of an operating lease together with it. Okay, so that's next week. Are we early today? You want to do another question? No. All right, leases for next week. I don't like to start a new topic in the week because then when we pick up, you don't know where we are, isn't it? So I prefer